afternoon, everyone, and thank you for attending our webinar series today. My name is Tyson Mavar, one of the Chevron Focused retirement advisors for the retirement group here in Texas. And good timing on today's webinar going over the Chevron pension plan. We just within the last 2 hours received updates on the May interest rates that affect Chevron pension lump sums. So we're going to go over those rates today, the implications of those rates for those of you that are approaching retirement or maybe approaching benefit commencement date for your Chevron pension. Before we go into any of that, I want to introduce any of you who are as familiar with the retirement group to our company. The retirement group is an independent financial planning organization that specializes in managing retirement assets for corporate employees. And we, in addition to that, help people plan for, prepare for their transition from, in this case, Chevron. Chevron happens to be one of the companies that we've worked with employees for several decades. And we hope that if you choose to work with an advisor in retirement, that you at least consider our company. There's a whole host of various complementary services that we have available for Chevron employees approaching retirement. In addition to our webinar platform, we have a retirement cash flow analysis that we do on a complimentary basis for anybody who joins our webinars or anybody who's willing to spend a few minutes with us. And we found that that's a great way to not only start the retirement planning process to see where you stand, but also figure out things like when's the best timing for your retirement, what's the best pension option, comparing the lump sum versus the annuity, what's the best timing on Social Security, how much can you afford to spend, what's the most efficient tax strategy for distributing your assets in retirement. All of these things we look to identify in the cash flow analysis, and we strongly encourage you take advantage of this if you haven't done so already. In addition to that, the retirement group is an independent advisory firm. We're not affiliated with Chevron. We're not endorsed by Chevron. In fact, we're not even connected with Fidelity in any way. As it turns out, we use Charles Schwab as a custodian. So our retired clients from Chevron have their accounts at Schwab, and we help them manage the investments as well as the distribution strategy on those accounts. We encourage you to spend some time with us. If you haven't done so already, there's no obligation to do business with us. If you schedule a web meeting, a phone call, or even an in-person meeting, our goal is to help you have all the knowledge that you need on your retirement strategy from Chevron so that you don't make any mistakes that are irrevocable and so you have the most successful and comfortable retirement possible after you leave Chevron. Now, we do record these webinars and we have a whole library of webinars. If you haven't done so already, I encourage you to follow us on LinkedIn. There's a QR code that will give you access to our LinkedIn page so you can keep up with the various changes on the benefits plans at Chevron and the different retirement strategies that we focus on with our clients. And there's also a way at the end that we will give you to schedule a meeting with myself or one of our other Chevron focused advisors throughout the country in the event that you might have some interest in spending some time with us. Now, the retirement group has been around since the early 90s, and we have clients from Chevron as well as the various other heritage companies going back to the late 90s. Texaco clients, Gulf clients, I have quite a few of here in West Texas. We have Unocal clients, Getty clients even prior to the merger with Texaco. And the point is that all of the plans are different depending on your genesis with the company. Wherever you start, a company is going to define which benefits you qualify for. And you may have some additional benefits depending on where you started your career. So we want to understand this first and then put together a game plan on your retirement that's consistent with the options that you have as a result of which company that you started your career with. Now, what's consistent among all of the different pension plans and among all employees, regardless of where you started your career, are the payout options on your pension. So I'm going to zoom in here so we can see all of these. Of course, the lump sum has been very, very popular in the last decade as interest rates have continued to decline and lump sum payouts have continued to increase. But as it turns out, there's other payout options that we strongly encourage everybody to at least take a look at as you understand what is important to you about your retirement and what your family objectives are. And it might just be you, but if you have a spouse, maybe children, maybe other dependents in retirement, it's very important that you compare the various payout options on your pension so that you have confidence you're making the right decision once you leave the company. And it's not always the lump sum. Now, as it's become more popular, we're seeing interest rates start to go up, and as a result, lump sum payouts start to go down. We anticipate that annuity options will become more attractive over time as interest rates go up. because the annuity option is only going to continue to grow as you continue to work for the company. The lump sum, on the other hand, has some implications of not only interest rates, but also your life expectancy and age, meaning that the older you are, the less the company has to give you as a lump sum, with the exception of some age penalties that you might still have if you're leaving the company prior to age 60. Now, in our cash flow analysis, we'll compare the lump sum with one or multiple different annuity options. So you can see, given the assumptions that we're making, given the assumptions of your life expectancy, the rate of return on your money, inflation over time, which option is likely going to be better for you. And only you can make a good decision on this, but our goal is to help you be armed with the information you need to make a good decision. And think about this well before decision-making time, because it, for most people, is a very stressful transition leaving Chevron. And the earlier you start this planning process, the less stress we've found that you will have throughout this transition, which is always a good thing. You also have potentially some age penalties. I'm going to zoom in on this chart, which is a table that looks at your total points of age in service on the top row against your age at the annuity start date on this far left column. Now, most people have at least 55 points when they leave Chevron, in my experience at least. So if you're 45 with 10 years of service, you could be 40 with 15 years of service, and you'll be on this far right column of greater than 55 points. So you can see you could still take your pension at age 50 and walk away with half of the full benefit. And even when you leave the company, you can continue to defer the election of your pension, and it will continue to grow by roughly what looks like 5% a year, but it actually ends up being more than 5% of the year, 5% per year when you do the math. To the point where you will be receiving 100% of your pension if you either retire after age 60 with at least 55 points, or you retire and wait till age 60 to take your pension. And there's been a variety of circumstances where we've encouraged our clients to wait to take their pension, and mainly because of these age penalties and the ability to age out of these penalties. However, if you leave the company and do not take your pension, you are still subject to interest rate risk. And this year especially, we are seeing that to be a very big risk of people not only leaving their pension with the company, but continuing to work at the company in some cases. We're seeing some people may be working for free this year as a result of the losses that are happening within their pension lump sum. And this is why it's a great time to update your retirement plan. Maybe consider even a different time frame for your retirement. Maybe consider leaving Chevron and getting a job somewhere else until you start to look at these other possibilities, these other avenues for retirement. You might not know what could be the optimal retirement strategy to maximize your retirement income and maximize what you walk away from the company with. As it turns out, we're also in a bit of a valley in terms of the stock market, with the exception of oil and gas stocks. So there's a lot better bargains available within the stock market. And in fact, bonds are even paying more than they were 6 months ago as a result of these interest rate hikes. So my point is, it may be a good time to invest money, and it might be a good time to have access to a large pool of capital, which could be your pension lump sum. Now, probably the most important slide of today's discussion has to do with the interest rates and what's happened this year and how that affects your lump sum. So I'm going to zoom in on this one as well. What you're looking at here on top are the May, April, and March corporate bond interest rates. The way the company observes the lump sum calculation is they're going to take the third, fourth, and fifth month prior to the month that you are commencing your benefit. They're going to use those interest rates to calculate your lump sum. As a result, you can see below here, we have the August 2022 blended rates, which are an average of these 3 months corporate bond interest rates. So you can see first segment 2.89, that affects the first 5 years of your annuity payouts. Second segment is going to be 4.17 in August. That affects years 5 through 20 in retirement. So effectively 3 times more relevant than the first segment rate. Then you have the third segment rate, just barely larger than the second segment rate at 4.27, and that affects years 20 through life in retirement. The second segment rate carries the most weight in the calculation, so this is the one that we focused on most when we're trying to figure out where somebody's pension lump sum is going in the future, and might it be a good time to retire and take that pension to avoid further losses. But we've also looked at the blended rates going all the way back to January. And you can see we started the year at 2.60 in the second segment rate. Now we're up to 4.17. We're already more than 1.5 percentage points higher than we started the year, which translates to roughly a 15% loss in pension lump sums, purely based on what's happening with the interest rates. Now, if you're under the age of 60, that relationship could be even more severe. You might have lost 20% in the last 6 months as a result of a 1.5% increase to the second segment interest rate. Now, fortunately, there's a good modeling tool, and we're delighted to spend some time with you to walk through that modeling tool, not only to help you calculate your current pension, but also see, given certain expectations about the future, assuming interest rates continue to go up, what happens to your lump sum? And do we need to change the retirement plan as a result? Might you want to consider saving more in your 401k plan now? Maybe you want to retire potentially earlier, or leave Chevron at least earlier than you originally anticipated. Or it might mean you might need to cut some things out of the budget going into retirement to still have a sustainable retirement plan. But it's good to know these things ahead of time and understand the risks of continuing to work at Chevron, at least as it pertains to your pension plan. And something else I want to mention is the timing of your retirement. So we now have the information available to run projections comparing an August commencement to a July commencement to see how much money you might be losing on your lump sum by working into August. But as it turns out, to commence your benefit in August and receive the August interest rates, you have to have been retired by July 31st. And by the same logic, you have to retire by June 30th, which is 8 days from today, in order to lock in the July rates and avoid losses associated with the higher August interest rates. So the importance of this, even if you're not ready to leave the company as soon as the end of this month, you can now at least see that there's a very short window of opportunity to take advantage of the knowledge of what's happening with the interest rates. So it's very important to pay very close attention to this, or at least talk to an advisory firm that pays close attention to this for you. And as a result, you can end up leaving the company with more money, having more money in your retirement plan, and of course, less risk of running out of money throughout retirement. So we've spent a lot of time on this, and we're delighted to talk about your specific situation if you're willing to spend a few minutes with us on the phone. But those are the important things that we wanted to cover today. I'm going to open it up for questions just in a moment here, but if you have any specific questions or would like to schedule a meeting with us, you can email us at info@theretirementgroup.com. You can call us at our home office at 800-900-5867. You can take a picture of the QR code on the left here to schedule a meeting directly with one of our Chevron Focused advisors. And again, that LinkedIn QR code, if you'd like to follow us on LinkedIn, great way to keep up to speed with the changes in the benefits plans and various Chevron retirement strategies. So it looks like we do have some questions. I'm going to open it up for questions here. It looks like one of our attendees said, if I don't have kids, what are the options for a pension distribution method? It's a great question. In my experience, the lump sum would be potentially attractive to that person, but if there's less of a legacy planning objective, in other words, if you don't care who gets your money after you pass away, just primarily looking at your own best standard of living in retirement, that annuity option tends to be more attractive to that person that is less interested in leaving money behind, or wouldn't care so much if they didn't spend all their pension and Chevron got to keep the money, compared to somebody who did have kids or did have a spouse, or maybe a cause that was important to leave money to. Now, as it turns out, you could still have a non-spouse beneficiary on several of the different annuity options on your pension. But in my experience, the death benefit is the most attractive feature of the lump sum, the flexibility to leave a sum of money to somebody other than a spouse, whether it's kids, siblings, family members, maybe a cause that's important to them, the church. These days, however, with inflation at over 40-year highs this last year, that's been one of the biggest concerns I've been hearing from folks about taking the annuity option, because the annuity options are not adjusted for cost of living, meaning the higher prices go in our economy, the less valuable that pension check becomes over time, and inflation becomes a risk of taking the annuity. Whereas the lump sum, at least you can invest those funds and possibly hedge against inflation over the long run. So lots of different variables on this decision, and it's an important decision because of the fact that it's an irrevocable one and that it could affect the rest of your life in retirement. A couple other questions, it appears here. Is the retirement group a fiduciary? The retirement group, as a registered investment advisor, is a fiduciary. And what that means is that retirement group has a legal obligation to make recommendations that are not in our best interest, but in our client's best interest, as far as we can tell. So that's why it's very important for us to ask a lot of questions, get to know our clients, their risk tolerance, their predispositions for or against different investments, their cash flow needs. And then we get audited on this. And we found that that's very important to our clients, whether it's us or somebody else that they might be working with, a feature of working with a fiduciary. All right, it looks like those were all the specific questions that we had on today's call. We do have another Chevron specific webinar happening next week, and we've added the link to the chat box if you'd like to join us. You could click on the link and register for that one, or you can call us at the home office. Again, our phone number is 800-900-5867. With that, we're going to wrap it up for today, but we thank everybody for joining us today. Everybody have a good, safe rest of the week, and we hope to talk to you all very soon.